Hello my friends, Jeff, Tax Rescue CPA. Today let's talk about how changes in life will affect your taxes. And I'm talking about the big ones, the big three: marriage, purchasing a house, and having children. All of these have a major impact on your taxes, and you need to be aware beforehand as you're living your life so that you don't have any surprises come tax time. All right, first up is marriage. Congratulations, you've tied the knot. Now, how is your tax picture going to look with this new relationship? Well, this is generally a good thing. Filing jointly will generally give you a better tax picture than when you were two single people filing separately. Now, speaking of filing statuses, a big question for a lot of people, at least initially, is should I file jointly or should I file married filing separately? Well, to give you the heads up on that, most of the time, like 98% of the time, married filing jointly will give you a better tax result. There are only a few unique circumstances, so unique that it's not even worth going into in this video, where married filing separate may be better. Now, there may be some other reasons in life going on where you may want to file separately, but for the most part, the best tax result is gonna come from the union and married filing jointly. So be aware of this, and your pro tip on when you get married is to make sure you change your W-2 with your employer or employers to account for this changing picture in your tax life. Okay, next up is buying a house. Again, like getting married, congratulations, this is a big step. Now, what changes in your tax picture when you buy a house? Well, the first thing is you're probably going to have a mortgage, and that's going to produce deductible mortgage interest. The other item that becomes deductible is property taxes. Now, to be honest with you, before you get too excited, the standard deduction a few years back was increased significantly, and it has reduced the number of people that actually benefit from itemizing their deductions. So while it is absolutely correct that you have more tax deductible expenses, you may find yourself, at least with the first house, that deducting or taking itemized deductions really won't end up with a huge benefit for you. The other thing to keep in mind is there are improvements you can do. There's credits you can have. One of the big ones now is the solar credit. And if you install solar, there's a huge federal credit that you can take on that. So there are things to consider when you've purchased that first house. Okay, next up, you had a baby. Yes, congratulations. Welcome that new member to your family. Now, having children can be a huge impacting event on your tax return for the good. Right off the bat, there's the child tax credit. And this one is a benefit for most people. The income threshold is relatively high for this. And so most folks having their first baby are going to see a fairly significant credit in this. There are other credits available too when you have children. There's the dependent care credit that's available to help offset daycare costs. There's some little nuances to this. Be sure you look into this into the details before you count your chickens on this one. And then the other thing that happens is if you qualify for the earned income credit, having a child or an additional child up to 3 can increase the amount you receive from your earned income credit. So that can be a huge benefit. Pro tip is, keep in mind you need a social security number for that new baby. Without a social security number, you can't claim them on any tax return, on any form, anywhere. So get that social security number straight away and start taking the benefits. Okay, now what about when the kids get older? When they're growing up, how do things change? Well, there are a few steps to watch out for. The first one is the dependent care credit or the child care credit is going to go away. The big one, though, that I want you to be aware of and take away from this is that when your child turns 17, you will no longer be eligible for the child tax credit. You may be eligible for the dependent credit, but not the child tax credit. And there's a big difference in the dollar amount of those. But on the flip side, if your child begins college and starts incurring eligible tuition expenses, there are a couple credits available for those expenses. The first would be the American Opportunity Tax Credit. This is the big one. This is the one that gives you a fairly significant amount of money, and you need to be careful when you use it because it can only be used for 4 years. So have a little strategy in mind when you're using that one. The other one is the lifetime credit, and that one is, well, it goes the lifetime, but it's not as generous as the American Opportunity Tax Credit. So keep those differences in mind and evaluate what's best for your situation. The other thing is to keep track of the college expenses. Depending on which credits you take, you may want to keep track of things like books and other fees and supplies so that you can maximize that credit for your student. Or, this is the other part, this is a whole other video, but the tricky part is the credit can actually be claimed by your child or by you, depending on the dependency. Okay, pro tip is like the 529 plans, start saving for those at the front end. The money will grow a lot better, faster, and your future self will thank you. Okay, so we've talked about the big three: getting married, buying a house, and having children. What else? What are the other ones that are going to affect your taxes in a fairly significant way? Well, some of these are kind of the opposite, is when you get divorced. That's going to affect your taxes, kind of in the opposite. Make sure you understand what your filing status is going to be and change your W-2 withholdings. The other event is get a new job. This can have a big effect on your taxes, and keep that new income level or income situation in mind, and change any W-2s or W-4 withholding exemptions accordingly so that you have the right amount withheld before the end of the year. And then the third one's retirement, okay? When you start to transition from earned income to unearned income, there's a huge impact on your taxes. And be sure you know which income streams that you have that you're taking, maybe you're taking withdrawals from, which income streams are taxable or not. That's where people get in trouble, is they don't understand which money is taxed and how. So those are three of the other, we got the three major and the three minor to keep in mind when those things happen in your life and what effect they'll have on your taxes. Now, if you need any help with these big changes and figuring out the effect on your tax picture, at Tax Rescue CPA, we're here to help. In fact, here is your personalized certificate to claim your free tax review. Get the answers you need. Thanks for watching. Now go experience life. Who's doing your taxes?